Thank you for that roaring welcome. That is tremendous. Stephen Colbert, eat your heart out. Thank you, everybody, for coming. My name is Will Feibel. It's not Stephen Colbert. I'm here with one of my colleagues, Ron Wieland, and he's actually going to be fielding any questions you might have. We'll take a couple of breaks in between me talking just to address any questions that may be outstanding. And, let's jump right into it. Before we get underway with the subject matter, which is a deep, dark secret unbeknownst to most people, let me just introduce our company. Netpicks.com was founded in 1996. Our principals are Mark Soberman and Brian Short, and we've been in this business for 16 years now. During that time, we've trained literally thousands of traders from around the world. We have about half of our client base here in the U.S. We're also very well represented overseas. Europe, large contingent in Australasia, and Latin America. Pretty much we cover all continents. Africa, we have clients. And one of the things that I think makes us a little bit special is the fact that all of us who work with Netpicks, we're real traders. We actually do trade. Every morning I'm out there, I'm trading crude oil, I'm trading the Russell, soybeans. My colleague Ron, he does the same, he trades the currencies. We're all traders, and most of us actually started out as clients of Netpicks. We all purchased systems and training from Netpicks at a time, at some time, and we have since joined the staff. So we know what we're talking about when we're talking about trading. We know all of the mistakes that we make because, believe me, I've made each and every one of them a couple of times over. And we know what it takes to succeed. So that's the company. That's all I'm going to say as far as plugging us. Let me move on to the presentation. All right, this chart should be familiar. This is what we're typically faced with every day. This is a chart of the euro-dollar on a 60-minute time frame. Most of us, when we started trading, we would use these time-based charts. Maybe we use something that's a bit faster, a 5-minute chart. Some of us started as position traders, so we were working off of weeklies and daily charts. But this is what we've grown used to. And you can gather a lot of information from charts. You can see channels, trends. You can identify trading opportunities, but it does get messy. On this 60-minute chart here, and this is up to right now, you see a lot of what appear to be very spiky moves in price. And those spiky moves are what present a lot of challenge to us when we're trading. It's very easy as you draw trend lines or channel lines. It's very easy to get ticked into or ticked out of a trade. The noise in the market is usually our enemy. So what we're going to be talking about today is something that's called Renko Charts. Now, I know there's a little bit of hyperbole in the presentation, in the introduction. Renko charts are not a long hidden secret dating to feudal Japan times. I actually had a whole story lined up where I was going to tell you about the old bricklayer in feudal Japan and how by accident placing colored bricks he came up with this concept. But that would be total nonsense. Renko bars were actually developed several decades ago, and I don't have the exact dates, but they do come from Japan. The name Renko, R-E-N-K-O, actually means brick in Japanese, I'm told. The Renko charts were really popularized, if you can call it that, here in the U.S. by Steve Nissen, never sure of the pronunciation, in his book Beyond Candlesticks. They've been around for a while. People have traded them and have been trading them for a while. But most people are really unfamiliar and I'll have to say, even uncomfortable with them. Now, the first thing you're going to notice about Renko chart is the simplicity. Renko charts are very smooth. Trends are clearly delineated. Channels are very clear. It appears as though there were no noise in these charts to speak of. And that's where the power of the Renkos comes in. Renkos have many attributes that actually make trading them or using them as supplements in your trading very advantageous. Few of the things that we can talk about when we look at a Renko chart is Renko charts are based purely on price action. Time is not an element. And this is one of the things that makes Renko charts challenging for traders. We're all used to trading the 1 minute, the 5 minute, the hourly, the daily chart, and Renko departs from that. Renko has no time dimension. So if I were to look at a bar right here, this bar was posted at 8:36. The next bar, almost an hour later. The bar after that, less than half an hour later, and so forth. The time intervals between bars are completely variable. You cannot look at a Renko bar and determine how long it took to form. If you look at the dates on the bottom of my chart, you'll see that not all days have the same number of bars. Some days have more bars, other days have fewer. So Renkos are completely independent of time. Renkos also do a perfect job of filtering out noise. And we'll look at that aspect of it a little bit closer later on when I show you exactly how Renko charts are built, how they're created. I've mentioned this already. Very clear indication of trends. So is there any question that we have a trend right here, that we have a trend here, here, or here? It's very clear. It jumps out at you. And channels. Channels become readily apparent. Let me just draw a couple of lines here. On channels, you don't have to worry about placing your support or resistance line exactly, because all of the channels have exactly, all of the bars that hit the channel have exactly the same value. There's no little excursions above or beyond it. So they make the identification of channels very easy also. It becomes very clear. We can have the horizontal channels, or in this case, slightly slanted channels, but it's very easy to pick out. If you think about it, you could use this for the simple reason, for the simple purpose of validating trends on an existing chart. If, for example, you have a system where you will always go short if the prevailing trend is down, then one way you could do it is look at an hourly chart, look at some moving average. The other day you can do it is just plop up a Renko chart. And if you're plotting a red brick, that means the prevailing trend is down. I'm just going to compare for a second the two. Here we have the hourly chart again and the Renko. And I've tried to get them to match as closely as possible the date. So they both kind of start on the 8th. And they both end right now, today. Compare the two. Notice this very nice trend up here, uptrend, downtrend, and this final trend here. When you look at it on the hourly chart, those trends are not as apparent, and the beginning and ending of the trends is not nearly as clear as they are with the Renko charts. This move down here on a Renko chart is a very nice, distinct, long trend. Very clean to look at, to work on my proficiency. So we've already spoken about a couple of these points. Renkos are based entirely on price action. They are independent of time. They are independent of volume. As you saw in the Renko chart I plotted, they do an excellent job filtering out noise and filtering out chop. They also very clearly, very unambiguously, show you where the support and resistance levels are on a chart. Trends, reversals, they become very easy to spot, and you could, as I mentioned, use a Renko chart just to confirm trends on your own system, on your own 5-minute chart or hourly chart, or you could trade a Renko chart on its own. And trading with Renkos is actually, I find, one of the simplest ways to trade. Stop management, risk management, it becomes very easy with Renkos. You can trade them on their own using just pure price action, or if you wanted, you could combine Renko charts with technical analysis indicators, just as you could with any other chart. And I noticed from the comment somebody's looked at range but not Renko, and absolutely, range bars are another interesting alternative, but we're not going to talk about those today. They're not quite as mysterious and exotic as Renkos. All right, so I'm going to stick with this presentation document, and I've just added this little chart so I don't switch back and forth between my charting platform and the PDF. All right, so we'll go over a couple of the basics of Renkos. I'm gonna give you the foundation of Renkos, and then we'll move on. We'll take a little break. If there's any questions, I'll try to answer them. And after the Q&A break, we'll move on and talk about how you can actually trade with Renko charts. So, Renko basics. Every bar on a Renko chart is called a brick. And that's because Renko comes from a Japanese word meaning brick, or so I am told. I don't speak Japanese. It could mean anything, but that's what I've been told. So every one of these red and green, sometimes they're hollow or solid, depending on your charting platform. Every one of these blocks is called a brick. And when we talk about Renkos, we talk in terms of bricks. You know, this is a 7-brick uptrend, or this is an 8-brick downtrend. So every Renko bar is called a brick. The second characteristic is that every brick is the same size. So again, going back to this little picture here, you can tell at a glance that every one of these green or red bricks is exactly the same size. And we specify the size of Renko bricks in terms of pips, or if you're trading futures, in terms of ticks. Gosh, I just had a lapse. All right, so this could be a 10-pip Renko bar, meaning the size from high to low on every bar is going to be 10 pips. Or it could be a 15-tick Renko bar, meaning that the distance from high to low is going to be 15 ticks on every bar. But every bar is of a uniform size. And in that respect, it is exactly the same as a range bar. Range bars are also same size. The difference from a range bar, however, is that in the case of Renkos, we never overlap adjacent bricks. Every new brick is drawn either above or below the previous brick. So going back to this picture, you will see that no two bricks overlap. Every brick starts where the previous one ended, or reverses, starts where the previous one also started, and they never overlap. You never have even 1 tick of overlap on these Renko bricks. So that makes them unique. And in that sense, it's very similar to point and figure charts, For those of you who've been around a longer time, you know what I'm talking about. Very similar to point and figure. Every bar is going to be above or below the previous bar. We never have any overlap in any of these bricks. And then the final point, and this is the one that trips people, this is the one that's hard to grasp, is that intra-bar, during the time that the bar is being formed, price can actually move above or below the brick. So that means if you look at any one of these bricks, before the brick was completed, before your charting package completes drawing the brick, price could have moved above it, it could have moved below it, it could have oscillated back and forth, and it won't be completed until it has moved a full brick size either above or below the previous brick. That's something that takes getting used to. Now, I had hoped, well, I didn't hope, I realized that doing this presentation at this time, there won't be much movement in the market. Things are going to be pretty quiet out there, so I can't show this to you live. So instead, I engaged the Disney Animation Studio Rookie Squad to prepare a time-lapse version of a Renko bar forming. So I hope this is visible. I know it is a little bit small, but you can increase the size of your chart. Here we have a Renko bar that's forming. You can see that it's not the same size as the previous bar. It's still a little bit smaller, but in the next slide we'll see that now it is. We have just completed drawing a full Renko brick. And this Renko brick is the same size as the previous one or as any preceding Renko brick on the chart. So we have the completed brick, and you can see here the little hash mark. That's where the next brick is starting to form. As time moves on, through the magic of time-lapse photography, we now see how this next brick price has started to move above the high of our last brick. And time moves on a little bit more, and the brick is now moving back down, back up. Now we actually have price moving below our green brick and back above. And it continues like this, moving back and forth, up and down, until we get to that point where the next brick moves the full size, the full 15 ticks or 10 pips or whatever we specified, moves the full distance, and then the brick is completed. And we repeat the cycle. We now have the next brick forming. Price action could move up, it could move down, and it's not until it's moved the full brick size above or below that the next brick is formed. So this is it's a really important concept to understand, and we'll get back to it when we talk about how you can trade Renkos and why it's important and why you want to keep this in mind. All right, price does move above and below the Renko. So if we are talking about a Renko that's the size of 10 pips, price could move 9 pips above and still not form a new Renko. Price could move 9 pips below and still not form a new Renko. It's only when price has moved a full 10 pips above or a full 10 pips below that a new Renko brick is formed. If we were talking, let's assume that this is a 15-tick chart of crude oil. Price could move 14 ticks above, or price could move 14 ticks below our brick and still not form a new brick. Price has to move the full 15 bricks above or the full 15 ticks below in order to form the next bar. All right, so that is basically the basics, the underlying concepts behind how Renko bricks are formed and how Renko charts are drawn. Same size bricks, no overlap, and we can have price excursions above or below the brick. All right, this is probably a good time for questions. There probably aren't any because I know that this is all very simple and straightforward, but Ron, if you want to pipe in, if there's any questions.
Yeah, no, Will, no real questions right now, so.
All right, thank you. That either means I've put all of you to sleep or everything is crystal clear. All right, so let's move on now. Let's talk a little bit about how we could trade Renko charts. And as I mentioned earlier, we can trade Renko charts. I just saw a question, does it work on MetaTrader? And we have a surprise for you at the end of the presentation, so just hold on. All right. Renko bars can be traded just based on pure price action, or you could trade it using indicators or a combination. So let's take a look at another basic Renko chart here. We already talked about the fact that we have trending and we have consolidation when we look at any Renko charts. And these two modes, if you will, the trends, the channels, we get that in any type of chart. It could be a 60-minute chart, it could be a tick chart, volume chart. You'll always see trends and channels. With Renkos, however, they're a lot clearer. All right, so let's consider how we can use this characteristic of Renko, the fact that trends and channels are so clear that noise is filtered out, how we can use that. So I'm going to pull up the chart again, the charting platform, just a second. Switch modes here. Hope I don't mess it up. And there we go. So we'll take a look at this Euro-US dollar Renko chart. All right. One of the questions is how do you define a trend on a Renko chart? And there's different approaches. You know, one is, oh, I just look at it and I can see it's a trend. At its very simplest, you can define a trend as a change in direction, a change in color. So starting on the left here, we have a change in color to red. That tells us we're now in a downtrend, and we will continue to be in a downtrend until we get a change of color to green. Now, as soon as we change color to green, by that definition, we are in an uptrend. Short uptrend, but that's what we've defined. So we just move 2 bricks to the upside, and we say we're in an uptrend. We change color again, and we say we're in a downtrend. So that's the simplest definition. And you can actually trade Renkos using that definition. You will get whipped around a bit, but it's totally possible. What's more commonly used? Most traders who are using Renko in order to trend trade actually require more confirmation. So for somebody who's trading Renkos, you know, just purely based on the chart, you probably want to look at 2 or 3 Renko bricks of the same color. So in this case, we would say that we are in a downtrend once we have 3 red Renko bricks or 2 red Renko bricks. And situations like this one, where we have a single green brick, do not indicate a change in trend. Down here, where we have 2 or 3 green bricks, then we can say that, yes, we are in a new trend. The other mode that we consider is Renko channels. And obviously, let me just go back here. Obviously, with that type of definition of a Renko trend, you can definitely trade at least portions of this chart. And I'm looking at a 25 pip Renko chart right here. I should have mentioned this earlier. So this is a 25 pip Renko. Every brick is 25 pips. All right. Channels are a little bit of a different beast when it comes to trading. Although we can clearly identify channels, trading channels with Renko is a bit more challenging. Unless you consider channels on a larger scale, any kind of channel fading that you attempt here will be very limited. So just for example, assuming we've established with this double top and this double bottom, we've established a channel. We now bounce off the top of the channel. You will want to wait until you have at least one reversal brick before fading this channel. And as you can see in this example, you really only have 2 bricks of movement before you get to the bottom of the channel. So you could fade it, you could use the channel to fade, but it's much more limited. Fading channels with Renko is much more limited, and really the best way to trade Renkos is by trading the trends. You could also consider these movements inside the channels as mini trends. You know, you could, if you're looking at only a single brick definition of a trend, you could just trade them as mini trends. More commonly, what folks will do when trading Renkos is just to use the channel for confirmation of a new trend. So you wait for a breakout of the channel, as in here, to indicate that the consolidation is over and the trend is resuming. All right, and obviously here you're going to pull back into it. Notice this channel has held. We haven't broken it to the downside, and once you've broken it here, you could have stuck through it for this very nice move up here. All right, but channels in general are much, much more limited in their potential than the actual trends are. So let's consider what a Renko system might look like. And I'm going to posit, suggest a very basic, very simple starting point for developing a Renko system. And it'll harken back to the definition of a trend that I talked about. I said how we can identify a trend as beginning with a series of bricks of the same color and ending with a change in color. So for argument's sake, let us say that we will require 2 bricks of the same color to indicate the start of a trend and 1 brick to indicate the end of a trend. If we use that definition, then in this case, we would have our beginning of the trend right there. We have 2 red bricks, and the end of the trend comes right here. A change in color. So for this move, we made 1 brick. This was our profit on this move. 1 brick is 25 pips. I would be quite happy with that. Let's look at the next leg. The next leg, we wait for 2 red bricks here. We never did get 2 green bricks. And as soon as we get the reversal, we get out. So this was a break-even trade. We now move down. Once again, we have 2 red bricks. And we said that 2 bricks of the same color tell us that we have the start of a trend. So there's our beginning and the first reversal. That's our end. So right here, we end our trend. And in this case, we've booked 1, 2, 3, 4, 5, 6 bricks times 25. I think that's like 150 pips. So pretty decent sized trade here. And again, we can repeat the process on this small trend. Here we have the beginning of the trend, and the trend ends right here as soon as we have a single color reversal brick. And here we got another 1, 2, 3, 3 bricks, right? So how many bricks did we get in total on this leg down? 1, 2, 3, 4, 5, 6, 7, 8, 9. That was a break even, and we got one more. So 10 bricks, 250 pips. We did not capture the entire trend. Obviously, this thing moved 150, 100, moved a lot. 500 to 4,100. It moved a lot more than we got. But we still made a nice profit. You can continue with this exercise, and right here you have 2 green bricks, so you now have a long trend. And again, in this case, you go 1, 2, 2 bricks before stopping out. Here you have a short trend. You advance 1 brick, but you get stopped out. So here we had a 1 brick loss. The next trend we get right here, we advance 1 brick and we stop out. So we had another single brick loss. Yet another single brick loss. But we made a nice portion on this leg down. And you have to understand that you do want to filter out chop. And it's very easy to see once you've established the double top and the double bottom right here that you're now in chop. Here we have another couple of instances where we can make some nice money on these trends. So that is the basics of what really could be a very, very simple system. Now, looking at this, we see a couple of problems with it. One big advantage is the simplicity. And actually, I've run through, not this particular sequence, this was today, but I've run through the sequence, and you can make money out of these just by doing the very simple type of trend trading that I've been talking about. But it does have some limitations, obviously. It would be nice to capture more of the trend, right? We would like to get more. We give up a lot of the trend by waiting for the 2 bricks. And if you consider 3 bricks as the start of the trend, you're giving up even more. We also lose a lot by stopping out every time we get a single brick reversal. So that's obviously not something that you want to do all the time. You want to see if there's a way to avoid this. And then, you know, obviously, chop. And chop is the bane of all traders. We are working on a Holy Grail indicator, which will be completed at just about the time that hell freezes over, but we don't have it yet. So chop is something that we have to deal with. We can never anticipate it. There are technical indicators that will give us a clue that we might be going into chop, but nothing that can anticipate it with certainty. And the best we can hope for with chop is to minimize the damage that chop does to our trading. So I just told you here we have an example where a double top and a double bottom definitely formed a channel for us. So we as traders can make the conscious decision that we will not trade until this channel is broken. It's not perfect, but it would have kept us out of at least 2 more losers. All right? Another thing we can do is we can actually add technical analysis indicators. So as I said before, you can trade this system purely based on price action. And when we were looking at these trends, we never really worried about stops and trailing stops because we knew that a single brick reversal was going to get us out of the trade. But we can add technical indicators and we can make everything a little bit more sophisticated. So let me get rid of these lines. And we'll start out with the most basic, and that's a moving average. Now I've preloaded on this chart default indicators from TradeStation. And I'm just going to turn on the moving average. This is a simple moving average. I did not do anything complicated to it. It's not adaptive. It's not weighted. It's not even exponential. It's not offset to the right or left. This is just a simple 9-period moving average. It's the TradeStation default moving average. So now look at this downtrend. And what do we see? We see a wonderful opportunity to do two things here. One is to get us into the trend sooner. So when we started this exercise, we waited for 2 red bricks in order to indicate the beginning of a downtrend. Well, what we could do here is take a break of the moving average and a single red brick as the beginning of our downtrend. So now we can call this right here, if I can get my hand steady, the beginning of our trend. The second thing that you will notice, and again, this is the most basic of moving averages. The second thing you'll notice is that even though we're getting these 1-brick reversals, none of them have pierced this moving average. None of them have closed beyond the moving average. So you could, for your system, consider staying in the trend as long as your bricks are below the moving average. And doing that, we get to stay in the trend until right about here when we finally get a bar that closes above the moving average. Or you could modify your rules and say that you will exit your trend once you get 2 bricks of the opposite color. So we just solved 2 of the issues that we have with that original system. We've now managed to capture a move from, let's see, 40.50 down to roughly 35.75. So I don't have my calculator, but I think the answer is that's a lot. All right. On a trend like this, now right here, we still haven't resolved fully the question of what do you do in chop. But if we assume that we have broken out of our consolidation, we can look at things like simple pullbacks towards the moving average, going long, and then there we go. We got another 3 or 4 bricks on this up move. Here we have a situation where this system would have stopped us out with a 2-brick loss, but then we get right back in there and we stick it out for another 1, 2, 3, 4, 5, 6, for another 6-brick trend. And over here, nice break of the moving average, and we can stick with it until we get right down here. So 1, 2, 3, 4, 5, 6, 7, 8 bricks times 25 pips. So that's what, 200 pips. The beauty of it is the simplicity, all right? So you are not agonizing over, oh my goodness, I just had a stray tick or a stray pip move across my moving average. The moving average itself is a lot smoother than it would be if you applied it to your hourly chart. The trends are very easy to identify. Anything that has air between the moving average and the bricks, that's a trend. And the reversals, very simple. A close across the moving average, and there you go. So that's one thing that we can do to improve the performance of our system. Now we can get more sophisticated too. So chop is always the nagging issue for us as traders. Most of your charting packages come with a variety of indicators that you can use to help you. You know, the CCI, Bollinger Bands, channels, MACD. I'm going to plot the ADX indicator on the chart. And the ADX can be used in a couple of ways. One method is any ADX value above, and you pick your level. 14 is popular, 25 is popular, whatever you decide to do. Anytime ADX is above that value, we are trending. If it's below, we're in consolidation. Or the way I prefer to use it is as long as ADX is rising, we're in a trend. Once ADX falls down, once ADX drops, we are outside of a trend. So in this case, and again, I just used the TradeStation defaults for ADX. I did not come up with a custom value. So what we see right here, at right about the time that we crossed the moving average, you see that the ADX is starting to drop. So you could say we are now leaving trending mode and entering consolidation mode. And this would actually keep you out of all this price action here until it starts to rise again, which happens just about here, and which happens to coincide with a convenient pullback and entry into this trend. Now you do miss out on some trends. We would be missing out on this move, and actually we would also be missing out on the bulk of this move down here. But, you know, you have avoided a lot of chop, you've captured the big trend, and you've captured this little trend. So ADX is one method that you can consider using, by no means the only one. So let's look at another one.
I was going to say just a couple questions. Someone was asking about Kagi charts, and then about a 9-period MA, if you thought that was the best.
No, I haven't. I haven't compared it. I have looked at them. I've also looked at 3-line breaks. There's a couple of others. For me, Renkos have proven to be the easiest to understand and actually the easiest to physically trade. So we could consider doing another presentation on Kagi charts at some point, but for right now we're going to focus on this. And I did not try to optimize that moving average. I went to the TradeStation indicator library, and I just plopped on here the default moving average. This is TradeStation's default simple moving average. The ADX that I showed you was also the TradeStation default, and the MACD that I'm showing you here is also the default. I'm sure that by trying to customize, you could improve on it, on the performance, but I've just started out with the default, because what we really want to cover are concepts and ideas, as opposed to a specific system. If I were giving you a specific system now, I'd have to charge you for it, and then, you know, your spouse would get very upset. So I'm not going to do that. But you can use this as a starting basis for developing your own. So continuing with the chop question, one of the other things you can do to try and reduce chop is use some kind of confirmation of trend. Now, obviously, the moving average confirms the trend. You could also insert something like a MACD or a CCI indicator, which I like very much. And all you're looking at is that you're only going to go in a downtrend as long as the MACD is negative, and you're only going to take long trades as long as the MACD is positive. So you would still get chopped around in here a little bit, but you wouldn't be taking any of the short trades, right? MACD is positive throughout this whole distance. MACD is positive. So you would not be taking any short trades. You would be taking long setups. So you could be in this long, stop out. This long, stop out. Maybe you made a break. It's a long, you're stopping out. Long, long, you'd only be going long, and right over here you wouldn't be going short right here because the MACD is still positive, but instead you're going to go short when you get your little pullback that allows you to get back on board the trend. So that's another method. The CCI is very similar to the MACD. Let me just get rid of the MACD and insert the commodity channel index. It's a little bit noisier. We can use probably different values for the length to smooth it out and turn it into a histogram. But again, this will allow you to confirm a trend. And as long as the CCI is positive, you're only going to take long setups. When it's negative, you're going to take short. This is the default, so I would definitely increase the length, the period of this one. Another look at it, another way to look at reducing the chop is to request more confirmation on directional reversals. And, you know, Bollinger Bands have been around for a heck of a long time. Everybody knows how to trade Bollingers. But one of the things that the Bollinger is going to tell you is when you have these bulges in the Bollinger and the bulge starts to contract, that usually indicates a change in direction. So with this existing trend we were working with, right about here, we would be looking at a change in direction. And we would favor, not necessarily trade, but at least favor the long side. And we would favor the long side until we get the same effect in the other direction. So right here, you see the bulge is starting to turn. That would say now we're going to favor the short side. All right. It's a little bit more laggy than the MACD directional filter, but it also works. And you could use it as a secondary form of confirmation. Okay. And down here also, you see the bulge is ending. So this says at this point, we should favor the long side. So that's an interpretation of how we can use the Bollinger Bands. And let me see if there's any more here that I want to introduce. Everything else works pretty much off the same concept. You could use the stochastics, and with stochastics, you know, you can use the crosses of the stochastic over their moving average to confirm directional changes. You could just use the levels, and anytime that we've crossed the stochastic below 20 or pick your level, you know, that means we're in a downtrend. So you can just stay in that downtrend until it ends. And then when the stochastic is maintaining itself above the upper line, the 80, then you're basically in an uptrend. So it's just another confirmation. Of all of these, my personal favorite to use in combination with the moving average is really the ADX. And I like the interpretation of ADX that says we're trending as long as we're going up. We're not trending as long as it's going down. And for those of you who have done some programming, it's something easy to test out. For those of you who don't do programming, you can test it out manually. You know, again, in this very simple example, as soon as we get the downturn in the ADX, that tells us we're entering chop mode. So we already know that from here all the way to here, we're not going to take any trades. This whole area we consider chop. The only downside of this is it lags a little bit. It's not perfect. And the other downside is that at times you will miss trends. And the best example is this one right here. So we were still moving down on the ADX when this trend started, and we really didn't get any pullbacks that we could take advantage of to get on board. And then here it's turning down again, so once again we're entering chop. So it's an example. I'm not suggesting that this is a system that you should use, but I'm showing you that it is a starting basis for a system that perhaps you could develop on your own. And you know, it's very easy to work with these Renkos, very easy to apply technical indicators to them. And just by using the simple moving average and the ADX, we've managed to, I believe, greatly improve the system that we started out with. We've managed to capture this huge trend down here. We avoided all of this chop. We managed to capture this little trend. We managed to capture another portion of this downtrend. And we did miss out on this one. but we did avoid chop in here and in here. It's quite possible also to do very complex, I should say, not complicated. It's also possible to build complex systems that are based on the features and characteristics of Renkos. And I'm just going to give you a quick glance. I'm not trying to sell. I'm just going to give you a quick glance at some of the things that we've done at NetPicks that take advantage of the capabilities of Renko. This is a modified version of our high-velocity market master system that uses Renkos. It uses confirmations from other indicators. It uses, similar to the moving average, it uses a trailing line, if you will. And again, very simple system. It's easy to work with the Renkos, and it gives us some very nice results. We just released a system called Keltner Bells that takes advantage of some of the channeling features of Keltner channels and combines it with the power of Renko bars in order to give us, again, some very nice swing trading opportunities. And even our mainstay system that we've been selling for over a year now, the 7 Summits Trader, works just fantastic with Renko. You know, this is crude oil from this morning, and we had some very nice trade. This is a 10-tick Renko chart. We captured some very nice short trades, some pretty nice long trades. We almost had a loss, but we avoided it. And all of this happened in the period of about 1 hour. Doesn't always give you winners. You know, we do have, if we continue trading into the lunch hour, we did have a couple of losses, one here, and I think this one ended up working out. Yeah, that one ended up working out nicely. We finally stopped out right here. But you can build very complex and sophisticated systems. So this really concludes the body of our presentation. I don't want to belabor the Renkos anymore. If you're not convinced yet that Renkos are for you, I'm going to suggest plop them up on your chart and just give them a spin. I think you're going to like it. There's a few other points I wanted to make, but first, Ron, do we have any other questions? Or has this all been crystal clear?
No, that's about, maybe I'll slow it down just a little bit. This was off the 0.6 that one of the folks in the room here was saying, had I looked at a 0.6 or a 0.4. So again, it got this nice winner. It went long at, I can pull the data window over here, and you can see where it went long at, 1128.6. Obviously, you'll have to adjust that around a little bit, because obviously that's the one thing on a 0.6 versus using a 0.75 Renko. You know, you need to make sure that you're matched up with the tick of 0.25. So anyway, it goes into a nice long here, and then it trailed out right about here. Again, 2 bricks, and then you're out, and that's about what the calculator did. Again, get this nice short down to full target. Again, look at that, 2 bricks. This time our a little bit looser stop kept you in this trade all the way down to here, so about 1124.5. So another nice second trade. Anyway, so I just wanted to that was a good example. The Renko at 0.6 does look good. It compares, you know, the trading signals we're getting with the tick chart look great. So any other questions, I'll turn it back over to Will, and we'll get you guys any contact info, netpicks.com. Lots of stuff, free trial room. You can come watch us trade this every morning if you like. And so we've got, there's a free trial at netpicks.com. So take it away, Will.
You guys have sat through listening to me drone on for quite a while, and as a little bit of appreciation, we'd like to give you a gift. And the question was asked earlier, can you trade Renkos with any platform? The answer is not every platform, but a lot. TradeStation and NinjaTrader have a built-in Renko. We are going to give all you MetaTrader users, this is for MetaTrader, we're going to give you a complimentary plugin that will allow you to trade Renko and range bars on your MetaTrader platform. All you need to do is go to netpicks.com/thank-you, and let me add, thank you very much, in order to get your download. This will allow a MetaTrader user to create range and Renko bars. You already know they're going to filter out the chop, churn, and noise that are common to time interval tick and volume bars. And here's a little tidbit I did not know, but apparently Brazilians developed the range bars. So, good stuff. And it's free. So thank you very much. Go to this link, netpicks.com/thank-you, and get your free gift. And if you want to find out more about NetPicks, if you liked what you heard today and you're curious, you're welcome to send us an email at info@netpicks.com. We also have some free online trading lessons besides this one, which we will be posting. We also have other online trading lessons. You can get it at netpicks.com/OTC trading tips. There's a software which is independent of charting platform. It's a standalone system. This is for those of you who already have Renkos on your charts. This is our gift to you, and of course MetaTrader users, you can certainly pick it up also. And as Ron mentioned, we do offer free free webinars besides this one right here. And we also offer some free trials for some of our services. So that's all that I have to say. Again, thank you very much. I really appreciate you folks sitting through this. And if you have any questions, feel free to contact us at info@netpicks.com. Bye-bye now.